Hello everyone and welcome to the Algo Systematics Trading channel. My name is Richie, and if you guys would like to make profitable trades that are low risk and high reward like this every single day, I have a weekly watch list that you can subscribe to for individual stocks backed by an algorithmic system with in-depth analysis also involving GEX data. Keep in mind these are not signals. I also have mentoring and coaching services designed to help you become a successful trader, backed and implemented with institutional systematic algorithms that are conceptual, with the goal of not keeping you as a student forever, but to give you a high quality learning program to make you a profitable and a successful trader to where you are prepared to go off on your own, whether you are a 0-day to expiration options day trader, swing trader, or futures trader. This will help you excel in all aspects. The links to my services will be in the description box below and in my bio. Today, I will be going over basic indicators that I use to help provide clues and context for trading. Keep in mind that most indicators are not a form of true alpha and can lag and sometimes can remain in extreme zones for prolonged periods of time. I have different methods for filtering out noise in terms of indicators. This strategy with my indicators is momentum based and will show you momentum entry zones, and there is more to it than meets the eye when it comes to perception of context. In order to have success with these indicators, it would involve knowledge over context, market structures, time frames, and more. Keep in mind that the markets are very dynamic and involving multiple moving components with coordination, and at the end of the day, it is all probability based. I am not responsible for any gains or losses that you make, and this is only for educational purposes. I will be going over some of the basic necessities needed for your success using these indicators to help develop an understanding of context. These indicators are not my main source of alpha or confirmation bias. They're not a source of alpha really at all. But they are just significantly tools used to gather clues for context that is momentum based, or measurement tools, which results to gamma scalping if you're trading options. They're measurement tools for measuring momentum and strength. My main source of alpha and confirmation bias is market structures and algorithms. I come from a close-knit community that uses a specific system of algorithms to which I would not like to steal the spotlight from my mentor, Spy Day Trading, with his institutional ties and origins. My coaching program will only be just to simply accelerate your understandings of the market if you choose to learn trading from me. And it will indeed involve some of the algorithms and its systematic concepts for an overall generalization of familiarity to understand better on how they work. And that is the main source of alpha that I use, the algorithms. The algorithms, along with the market structure, including liquidity zones and pockets, as well as basic context and basic market knowledge, is what my main confirmation is, like the GPS route. While the indicators are just a measurement tool like a speedometer to a car. April 15th, or sometime towards the end of April, I will be extending my invitation to you to the larger algorithmic community that I am part of. Hopefully, if you decide to do the coaching route from me, you would have already been caught up to the point algorithmically and systematically to where you won't be struggling with any of the terminology. And I will be teaching you almost everything that I know along with that. We may talk a little bit of math when it comes to vectors, linear algebra, scatter plots, matrices, and a lot more due to the algorithms. So let's go ahead and get started with the basic indicators, which is a crossover momentum method and strategy. We have, firstly, Bollinger Bands, with the 20 simple moving average as equilibrium in between the Bollinger Bands. The Bollinger Bands measure volatility by expanding and contracting to build up and release pressure. The 20 simple moving average, or the 20 SMA, is very important because it is a short-term equilibrium, and it follows price as a form of fair value price within the Bollinger Bands and within the last 20 candlestick closes in its given time frame that it is being observed in. So, for example, 1 minute, or the 2 minute, or the 30 minute, the 20 SMA is going to be different in every single one of those time frames due to the fact that they are going to result in different candlestick closes. So, yeah, 20 SMA is very, very important. While the true price for the session is indeed VWAP, 20 SMA can be a good support and resistance indicator measuring price trajectory by slope resulting from momentum. The 20 SMA has the last 20 candlestick closes as equally weighted for a smoother fair value average current price and slope of trajectory. We then pair this 20 SMA with a crossover method involving the 9 EMA, being the 9-day exponential moving average. The 9 EMA measures the most recent price, to which the most recent price equates to 20% of the weight that the 9 EMA uses for its slope of trajectory, tracking short-term momentum bursts. So the 9 EMA will be a lot closer to current price compared to the 20 SMA, while the 20 SMA will be a lot further, and it'll be closer to the actual price's true average true price within that given time frame. So we're going to go ahead and stop here real quick, and we're going to go ahead and go over this real quick. Tuesday, April 7th of this week, of last week, of the last trading week before this coming Monday. Tuesday was a really good day. A lot of good moves, especially towards the end. And Tuesday is also a very good day to go over a lot of the structure that is needed as well. So we can see here that the 9 EMA crossed below the 20 SMA, resulting into a bearish trend. It tried to cross over but failed, and it grabbed liquidity off of the supply zone, being the 5-day moving average, and it rejected and it kept going. 9-day never really crossed above it again until right here, measuring and resulting to a change of trend. And we will be going over all the other indicators as well, but we'll just go over this first. So it never crossed up until, well, it became bullish, and then it became bearish again, bullish. Now this is important. This is where the other indicators come in, and your knowledge of market structure comes in as well. Candlestick patterns are very important, as well as volume nodes, which on SPX I don't use volume nodes because they don't really work. I use the SPY or QQQ. And we can see here that although 9 EMA crossed underneath 20 SMA, it wasn't completely bearish. You can't go off of indicators crossing first. And this is where you go up into higher time frames. We can see here that on the 2 minute, the 9 EMA never crossed underneath the 20 SMA after this point here. So it was still bullish. It was just simply a liquidity trap for set up by the bulls to trap the bears to head up higher. So yeah, we're gonna be going over a little bit of some market structure too. Now we're on the 1 minute. again. And I'm going to go ahead and talk about the market structure now. So firstly, before you make any trade, before you have any type of bias, before you have any type of analysis, you have to do top-down analysis. You have to go from macro to micro structure conversions, which in our case and in our analysis, it is very fractal. I usually go to from the 1 month down to the weekly, down to the daily, down to the 4-hour, down to the 30-minute, down to the 15-minute, sometimes 10-minute, but not really. 15-minute, 5-minute, 3-minute, 2-minute, 1 minute, and for even smaller micro structural analysis, I even go down to the 30, 10-second, and 5-second. Now, we will be going over. I saw some stuff about this today, and it was like this guru guy or some crap, and he was trying to overcomplicate pretty much. I mean, what he was saying was right, but I mean, it's just kind of overcomplicating things. But I don't know his name. I don't know these content people. But what I will say is that what he was explaining was simply inverse head and shoulders and head and shoulders patterns. Pretty much left shoulder, head, right shoulder. That's my cat, by the way. So I don't know if you can hear him or not. But anyways, okay, yeah, you can go on my lap. Sure. Anyways, so let's go over top-down analysis first, okay? Oh, actually, you know what? We'll go to the 1 minute, and I'll explain to you guys a little bit, and then we will actually go back into the top-down analysis, which is fractal in our case. So we can see here, and we're going to go. My mouse. Anyways, we're gonna come here, okay? Now, first of all, let's go over the indicators, okay? On the 1 minute, if you don't have room for multiple time frames, I usually have my daily, 30-minute, 5-minute, 2 or 3 minute, and then 1 minute, and then 30-second chart. And a 10-second chart, all open on all of my monitors right now, right here, okay? And I mean, they're all they're all quite needed for every bit of edge. Like you need as much edge as you can in terms of, and as much market context as you can in order to be exact, in order to really trade effectively, especially when like gamma scalping or trying to maximize your profits. So you really need all the edge you can get. And hopefully what you learn from me here today, for free, you will gain a bit of knowledge and insight on edge, from gaining edge. All right. So you can see here that bulls tried to head up here, but the bulls here were not strong enough. Okay. They tried to form a smaller micro inverse head and shoulders here to head up, but they failed. Okay. They tried again here. They tried grabbing this liquidity, being a left shoulder, head, right shoulder to head up, but they failed. And it actually turned into a head and shoulders pattern for the bears because, well, the bears are still in control of this liquidity zone, okay, of this level. So it resulted to what? Lower lows, lower high, lower low. But we can also take a look here in terms of market context. Now, even though we're making lower lows, MACD and RSI were making higher highs. So there was a inverse correlation. There was a divergence. There was a bullish divergence. What was happening was that the stronger bulls, the bulls with like more amounts of liquidity, were trapping the bears. This is what this content trading guy was talking about, the market auction theory. Which, I mean, he's not wrong, but I mean, this is inverse head and shoulders. So pretty much bulls grab liquidity here, trapped bears here, and bears obviously wanted to go lower, but they had to take their profit. So that developed the head. And we can see here that bears tried again for it to go down lower. Head and shoulders pattern right here. But it failed. Now, this right here is a zone of mutual interests. Okay. This liquidity right here was it was up for grabs pretty much. And the deciding factor of which way it would go would depend on pretty much which team would have more liquidity, more sufficient liquidity for efficiency. And turns out the bulls had the liquidity. So we grab the left shoulder, head, and this right shoulder. We grab that liquidity to head up. And guess what? Guess what happened? This is very important for later, because this liquidity zone here, okay, became a supply, not a supply zone, a support, a demand zone for later. Okay. Now we can see here, so bulls retreated here to gather up strength, right? And also, let's not forget, on Tuesday, the level of 6,600 was a very, very important gamma level in the derivatives market. And market makers really wanted to keep us below 6,600. We could poke above it sometimes, but that's their risk management. And since this happened towards the end of the day, they had to hedge their positions. Okay. So we can see here that throughout the entire day, market participants were simply building up liquidity to head up higher. And we'll see that, and this is going to be really cool, guys, okay? I promise, all right? This is going to be a surprise, all right? So, bears tried again. They retreated back up into the supply zone. They know that they're in a supply zone with 5-day moving average, 20-day moving average, and basic levels of supply resistance, okay? We can see here that bears tried again, and they thought that they were successful, but they weren't, all right? So, head and shoulders pattern here, okay? Left shoulder, head, right shoulder, headed down, but we headed down back to this liquidity zone. The bulls used it as support to create another inverse head and shoulders pattern. Okay, so there are these smaller head and shoulders patterns within these larger inverse head and shoulders patterns. Okay, so what that means is that pretty much bulls need to dig a little bit deeper to gather up stronger buyers. Remember, people, institutions, and banks, and you name it, anyone, okay? These content traders or whatever, they always talk about auction theory. And I mean, it is true. But I mean, it's just icing on top of a cake. It's just all language used to sound smart. Okay. But we can see here that there are these larger macro inverse head and shoulders patterns and these smaller micro head and shoulders patterns. So bears are very weak here because we're in a larger demand zone. We've been selling off for quite a bit of time within the last few weeks. All right. So we developed another inverse head and shoulders pattern. Grab the left shoulder liquidity, head, right shoulder liquidity. And we can even take a look here. Bulls tried here to head up. Okay. The inverse head and shoulders pattern was a bit uneven here. They tried again here to grab it, failed, too weak. Okay. But this liquidity here was floating. This liquidity here was used as a support, and it developed the head. Now this head, there is a smaller inverse head and shoulders pattern here as well. Left shoulder, head, smaller micro right shoulder. We headed up. What do you know? Okay. Now we developed a right shoulder. And what do you know again? A smaller micro inverse head and shoulders pattern. 1, 2, 3. Left shoulder, right shoulder, left shoulder, head, right shoulder. And we can even take a look here that there are even smaller micro inverse head and shoulders patterns within the micro inverse head and shoulders pattern itself. An even smaller one. 1, 2, and an invisible 3, but you have to go down to the smaller time frames. And just for you guys, let's go down to the smaller time frames. Why not? Why not? Why not, guys? You know? Do it for the content, you know? Thursday. Wednesday. Tuesday. Take a look here. What do you know? Oh. What do you know? Well, I guess there was no right shoulder here. But that's why we came back down and we grabbed a larger, or we grabbed a liquidity off of this demand zone here. So sometimes inverse head and shoulders patterns can be a bit lopsided. But yeah, actually, let's look at this again. I'm pretty sure that was indeed a right shoulder. No, it wasn't. But either way. Oh, no. Don't do that. Don't do that. Gosh dang it. I have 3 mouses and I don't know how many more mouses I need to get because they're all breaking. The scroll wheel is being annoying. Anyways, sometimes the right shoulder doesn't fully form. Now, that is on rare occasions, but it does happen. And what that could signify is later weakness for it to come back down, for that liquidity to be grabbed. But in this case, there was plenty of strength. Now, we're going to go to 30-minute, and we're going to use the same exact pattern. And we're going to see that the bulls have been planning this all along. Okay. I mean, yeah, of course, we are in a pretty good demand zone. But we were underneath the 200-day moving average, which can result to a temporary bear market. Okay. But if you're good with patterns, okay, you can already see that there is this larger inverse head and shoulders pattern that has been developing for more than a week. And bulls have been trying over and over again here to head up, failed. Here to head up, and they failed. Okay, but there are stronger bulls underneath. And they stepped in, okay, and they kept buying. All right. We could take a look here. Inverse head and shoulders pattern. They tried here, went up, failed underneath 20-day moving average. And they tried to form support off a 5-day moving average, but liquidity was not sufficient to head up from there. And we can see here from time to time again, every time we made a lower high and a lower low, resulted to head and shoulders patterns. One, left shoulder, head, right shoulder, down. Again, left shoulder, head, right shoulder, down. Left shoulder, head, right shoulder, down. But as we can see, there was a smaller micro head and shoulders pattern playing into a larger inverse head and shoulders pattern. And what do you know? We headed up. Bears retreated. Now bears are going to try again to develop a head and shoulders pattern, left shoulder, head, right shoulder to try to head down. And grab this liquidity to head down and develop a larger head and shoulders pattern to head down again. That's what they would love. But the bulls are in control now. Okay. Now, everything might not be done yet, but we can take a look here. That liquidity can be grabbed anywhere. It can be grabbed like this, left shoulder, head, right shoulder, go up even a little bit higher and develop another head and shoulders pattern here. Like this, and have it take forever. And then here. And then, but probably what the market wants to do is it wants to use the liquidity from the 200-day moving average to choose a true direction for the remainder of the year. Now we don't know exactly right now what can fully happen. And what probably will happen in the upcoming near future is that 20-day moving average and 200-day moving average are both going to kind of converge. And we might come back down and grab liquidity like this. Hit 1, 2, 3, and head up higher. Maybe. But 5-day moving average is catching up, and we can use that as support to head up a little bit higher. Although the strength is kind of weakening a little bit. A lot of market participants kind of want it to come back down again, because we'll take a look here in the daily. A lot of institutional buying programs. Whenever we get up to daily Bollinger Band, that signifies, number one, high demand, but number two, it can also signify a imbalance. And what can happen, that's why it's very important to pay attention to volume on the day, which we have to look at SPY. But we can go ahead and take a look here. That Bollinger Band is being overextended now. And we are headed into a supply. We are actually in a supply zone right now. So if stronger bulls are here, or if stronger bulls are interested, they'll probably come back down somewhere here in this area to grab liquidity. Now, anytime we do reach upper Bollinger or lower Bollinger, there will always be some kind of mean reversion back to 20-day moving average once a month, which you can also learn from by day trading. Now, there will be a rebalancing every month, and it will happen. Remember that, guys. Mean reversion will always happen in the markets. Okay? We don't know exactly when, but we can gather clues on when it might be. Okay? Anyways, back to the 1 minute chart. Hopefully you guys were able to learn something from that. Now let's go over a little bit of so we're having a combination of 9 EMA, 20 SMA, RSI, and MACD, as well as VWAP. On VWAP, I use the true value slope, which is in the middle, and then 2 outer slopes that are 1 standard deviation apart from the middle. Okay, 2 outer bands. Now, price can't stray away too far from the lower or the upper band. These 2 bands help signify that price is either in a very, very oversold zone or a very, very overbought zone, which can show high demand for selling or high demand for buying. While most, if not all, big transactions all happen at VWAP, which is also the true price value of whatever you're trading for the session. Always, all big transactions happen at VWAP. Anyways, now let's go back to Tuesday. Now, you guys can also backtest this strategy all you want. You guys can go back years and months and however far back you want. These indicators and this strategy is the same. It'll always work because this is just the basic statistical math behind everything. And we're going to get into a little bit of math when it comes to the adaptive moving average. So, anyways, now let's go over MACD and RSI. Because, let me drink some water real quick. As we can see here, that MACD and RSI both made higher highs. We can see here that RSI can be in a period of overextension, as I mentioned in the very beginning about indicators. In the very beginning of the video, I said that indicators can be in extreme zones for very prolonged periods of time. This being a very, very prime example. Price kept going up higher, while RSI kind of just stayed up here, but was slowly going lower, as well as MACD. Now keep in mind that RSI and MACD both have neutral zones. Okay, neutral zones being here, a form of an equilibrium line, if you guys want to think about it that way. Now we can see here that when we went over that bearish tried here to go lower with the head and shoulders pattern, it failed. And this liquidity was grabbed to go up. Now, you guys can look at the 2 minute and see that it was bullish, as well as the 3 minute, 5 minute, and whatever time frame. Maybe not 30 minute, but we can see here that MACD and RSI were both in neutral zones. And what happened was, well, even though we crossed down here, we were above the neutral line, and we used the neutral line and crossed up to head higher as well. It wasn't because of these indicators that it headed up, but these indicators helped us find clues to why it went up. Now, we can see here that MACD was headed lower, while price was headed higher. We crossed down a little bit below the neutral line, but 9 EMA and 20 SMA, the crossover happened. Now, here's another prime example of the right shoulder. Okay, yeah. Remember what I mentioned earlier? That about the right shoulder not being grabbed all the time. See what I mean? I keep buying new mouses and they keep breaking. So, I mean, what can I do? Just buy more, huh? Anyways, we'll see here, left shoulder, head, no right shoulder. So we can see that played a part into the head and shoulders pattern, because buyers here in this zone were weak. So the move was not real. It was real, but it wasn't the true move. The true move was over here. Okay. So, yeah. You can see here there is also a smaller inverse head and shoulders pattern. Left shoulder, head, right shoulder. Grab the right shoulder here, headed up. But failed. We kept going up past the 20-day moving average and past this high right here. And what ended up actually happening was we went for the high of day and grabbed that liquidity to prepare for the end of day move. So we didn't necessarily have the strength here to keep going up, but we did have the strength here to tag the equal high, grab that liquidity to build up some buyers to head up towards the end of the day for a final move. And also, I believe that it was also news driven, but that's besides the point. Okay. Some more prime examples. Inverse head and shoulders pattern. Left shoulder, head, right shoulder, headed up. We can see here that they tried developing a larger inverse head and shoulders pattern, but failed. And everything was very, very choppy and sideways. But we can see here, the next day, because, I mean, usually what happens during a gap up day is that usually there is quite a bit of sideways action, a bit of accumulation here. But we can see that the demand kept growing. Buyers accumulated here in this area, although they're a little bit weaker compared to the buyers down here. They're still relatively strong, and bears are having to retreat. You can see here, Thursday morning, buyers developed a inverse head and shoulders pattern off of the 50-day moving average. And the 100-day moving average acted as a temporary resistance. We formed, take a look here, another one, okay? Another micro inverse head and shoulders pattern to head up even higher. What do you guys know? Oh yeah, my timer. Anyways, so yeah, hopefully you guys kind of get my message. But yeah. Also, imagine that the Bollinger Bands are like a tunnel system. Okay. There are times of overextension, which means an imbalance in price, and we always correct back to 20 SMA and kind of ping pong. Okay. With the crossover happening. Now, we are going to get into the adaptive moving average. Oh, also, volume nodes are very important. Volume profile is very important for identifying supply and demand zones for liquidity and for price targets as well for sessions. And also, using the volume profile on the 4-hour chart is very, very useful. Now, we will be going over the AMA, Adaptive Moving Average. So, the Adaptive Moving Average, which can act as an EMA during trending directional markets and slow like an SMA during choppy markets. It uses two factors in equations using efficiency ratio, using this formula, which I will put on screen. It will result in two different results having a fast or slow slope and a smoothing constant, resulting to using this formula, which I'll put on screen. And both this smoothing constant formula, it blends both fast and slow behaviors dynamically. And then the result that you get from the smoothing constant, both create a final AMA formula of adaptive moving average equals AMA times the previous plus a smoothing constant times price minus adaptive moving average previous. So the AMA can also be regarded as a small form of alpha because, normal moving averages assume that market behavior is consistent, while the AMA assumes that market conditions change every second, making it adaptive, which is why a lot of quants use this tool and like it. It is the dotted slope that turns yellow and upwards when bullish, and red and downwards when bearish, or red and flat when sideways. If we take a look here and we zoom in, the AMA is this line, okay? This dotted sloped line. Yellow, resulting in bullishness. Flat, resulting in accumulation. Up in yellow for bullish, flat and red for accumulation. Red and downwards for bearish, even though at times it might turn yellow while being flat. Just remember, if the slope is flat, the price will remain flat for that amount of time until the market decides which way it wants to go based off of the sufficiency of liquidity. Also, the 3-minute and the 5-minute EMA are really, really good and important as they can act as really good support and resistance slopes. Now we have the daily simple moving averages being the 5-day, 20-day, 50-day, 100-day, and the 200-day moving average. We will go to the daily. We use the same crossover method to determine trend with 5-day moving average crossing below being bearish and 5-day moving average crossing above the 20-day moving average, resulting to bullishness. And we can see here that the 20-day simple moving average is starting to curl up. Okay. And also the moving averages act as price magnets, and they can also act as support and resistances. So, you guys learned that, So pretty much also we can see here that multi-time frame alignment. We saw in the 30-minute the same exact pattern, inverse head and shoulders that the bulls were behind. We were overextended on the lower Bollinger Band. RSI was oversold, or not oversold, but at the lower point with MACD crossing over. We have a lot of supporting indicators helping us to trade. Daily 9 EMA was acting as a good resistance, and then it turned into good support. So yeah, my goal here today was to introduce to you guys that I am legitimate. I'm here to help you guys grow and develop you guys. Whether you guys choose to learn from me or not, my content will be here. And you guys can always learn from it, as well as my mentor, Spy Day Trading. I am just simply here to help accelerate your learning. And yeah, these indicators was a little small taste of what I use as a little confirmation clue gatherer. Okay. And there's a lot of other sources out there that you can get for free that are educational for trading. So try to diversify yourselves as well as much as you can, and try to learn as much as you can from other people as well. To try to expand your universe and to try to broaden your horizons. But also, in terms of inverse head and shoulders patterns and head and shoulders patterns, we can see here that left shoulder, head, and it could be developing a right shoulder here to head down even lower. And we can see here that the bulls are trying to grab this liquidity or do this right here to head up higher, or grab this liquidity here to head up higher from here, and then kind of do something like this here, something like that. Okay. So yeah, if you guys liked this video, don't forget to like and subscribe. Don't forget about the weekly watch lists, and yeah, you can comment, ask me questions, and do requests for me, and I'll look into it. And don't forget about April 15th. If you guys would like access to my services, they will be in the description box below or in my bio. And yeah, just remember that the market is very, very trappy. There's liquidity traps everywhere. And having knowledge of this market context can really help you. Whether you are trying to do futures on some kind of funded account or do it on your own. I'm typically mainly an options trader, and I also market make. I market make now, but I still trade, and we still hit bangers sometimes, So yeah. If you guys want to see more content like this, don't forget to like and subscribe. And yeah. See you.